Hello, my name is Adam Ching, and I am presenting on private placement, due diligence, term sheet, and regulations from Professor Shiroki's Finance 139 class. Private placement memorandums are typically used when companies seek capital. It is argued that a private placement memorandum is amongst one of the most important documents for an entrepreneur. Private placement memorandums are legal documents that businesses and institutions use to describe the securities that they are offering. It generally lays out all the details of the investment opportunity to potential investors. The complexity of a private placement memorandum is high and therefore should not be taken lightly. A private placement offering is a way for small or growing companies to raise money. This type of offering does not need to be registered with the SEC. Essentially, the purpose of a PPM is to allow the entrepreneur the opportunity to inform the investor of the potential risks involved with the deal. As a general rule of thumb, it's always best to be as transparent as possible. What I mean by transparency is that an entrepreneur should put themselves in the shoes of the investor. From an ethics point of view, it seems obvious that as much disclosure should be done as possible. But when a deal is on the line, certain pieces of information might be left out that might potentially compromise the closure of that deal. For the best interest of all parties involved, it's always an excellent idea to get attorneys involved. This is due to the fact that compliance of national and state regulations are extremely important, and any misguided terms that may result in problems down the road, especially when approaching the initial public offering. Private placements have an exemption from many of the federal and state laws, which tend to be extensive. This exemption has the advantage of reducing ongoing costs as well as transactional costs. Among the benefits of private placement memorandums is one that allows a more rapid penetration into the capital markets than would a public offering. Regulation D is an integral part of public placement. Rule 504 of Reg D states that offers and sales of not more than $1 million during a 12-month period. Essentially, there is no limit to the number of or nature of the investors that participate in the offering. Rule 505 is an accredited investors and allows the sale of up to $5 million. Under this, there is an unlimited number of accredited investors and up to 35 non-accredited investors allowed, regardless of their income, net worth, or sophistication. Rule 506 has no dollar limit, unlike the previous two. Similarly to Rule 505, there is no limit to the number of accredited investors allowed to invest, and only 35 unaccredited investors are allowed. Full compliance with the federal securities laws is only one of the regulations that must be taken into account. Reg D was designed to provide a foundation for uniformity between federal and state securities laws. Term sheet. A term sheet should spell out the specific amount of the investment. It's in the best idea of the investor that before receiving a term sheet, one should consider that investors typically structure term sheets to protect themselves. In addition to protection, traditional investors usually try to structure deals to get as much money as they can out of it. Let's face it, investors invest for one reason: to make money. Generally speaking, a significant amount of entrepreneurs' time is spent considering valuation. This leaves less time to think about the structure of the investment. Valuation is an important topic, but it's not the only important topic. The three most frequently discussed types of stocks are common stock, preferred stock, and participating preferred stock. Common stock is the same stock that the founders of the company have, as well as anyone previously investing. Preferred stock is generally the most common type of stock. A benefit of this type of stock is that owners get priority ahead of common stock holders in the event of dividends or liquidation. Participating preferred stock is the most common type of stock for investments over $1 million and or by more sophisticated investors. This type of stock is similar to preferred stock, except that the investor gets their investment back and then joins the equity, just like the shareholders. When looking at individuals that invest in the companies they work for, it's hard to determine the ethicality of the way they invest. Technically speaking, every time an executive buys or sells stock in the company they're associated with, it can be considered insider trading. It seems obvious that CEOs have information about their company that no one else has. So what would prevent them from using that knowledge in terms of buying or selling their stock? It's so apparent that the executives do this. There's an entire school of investing that's been devoted to watching the trading patterns of executives. For investors, view this as legitimate insider trading. In the past decade, the SEC has created a system that they thought would prevent insider trading. This system would require executives to designate a date weeks in advance of when they would buy or sell stock. This system was good on paper but flawed in practice. The biggest flaw was that the fluctuation of stock prices occur after a news release from the company. If a CEO knows detrimental information is destined for the future of the company, he can wait until after he is allowed to sell his shares before releasing that information to the public. Due diligence is an important aspect that all financial investors and institutions should comply with. Generally speaking, due diligence refers to the care a person should take before entering into an agreement with another party. Due diligence usually refers to the review of all financial documents along with anything else believed to be material to the sale. This process of due diligence undertaken by a business is a precautionary step in the hopes of preventing a compromising result for the parties involved. Typically speaking, there are three areas of financial due diligence. The first area is an explanation of how you plan to use the funds. Secondly, an explanation of the budget, and third is a legal review. Being able to provide a realistic assessment of your business which clearly articulates the purpose of the financing, along with what those funds will be used for, is paramount. Due diligence generally refers to the background checks conducted after a party has already made a decision about the company. There is a comfortability factor involved which typically directs partners to invest in companies led by people that they know, and that people they find are trustworthy. Essentially, due diligence states that certain precautions should be taken. If not, they could be found guilty of negligence and be held criminally liable. Thank you for listening to my presentation.